Did you know that so-called free checking accounts cost Americans over $30 billion a year, without most people ever realizing it? Today, we're dissecting the business model behind free checking accounts, a service seemingly offered at no cost by almost every major bank in the US. Over 95% of Americans have access to free or low-cost checking, making this a multi-trillion-dollar industry at the core of modern finance. On the surface, most people believe banks offer free checking as a customer-friendly gesture, a loss leader to get people through the door. The logic goes, they make their real money from mortgages, auto loans, and investment products, so checking accounts are just an entry point. But understanding how free checking accounts are actually monetized reveals hidden incentives, exposes potential pitfalls for consumers, and highlights where the real risks and opportunities lie for investors in the banking sector. The largest source of profit from checking accounts is simple: leveraging customer deposits. Banks take the money sitting idle in your checking account, pool it, and lend it out as high-interest loans. The difference between what they pay you, usually near zero, and what they earn, sometimes 4 to 8%, is called the net interest margin. Every $1 billion in checking deposits can easily mean $30 to $60 million in annual profit for a mid-sized bank if loaned at just average rates. Next up, debit card interchange fees. Every time you swipe your debit card, the merchant pays a fee, a portion of which goes back to your bank, typically 20 cents to 25 cents per transaction. For a bank with 1 million active debit cards, these fees can generate $30 to $50 million annually. Another revenue stream comes from charges for ATM use outside a core network. But here's where the economics get controversial: overdraft fees. In 2022, banks raked in more than $8 billion from overdraft and NSF, non-sufficient funds fees alone. Despite being avoidable, these fees average $35 per transaction and disproportionately impact lower-income customers. There's also data monetization. Insights into your spending can be anonymized and sold to marketers, or used to cross-sell higher-margin products. For most consumer banks, the revenue mix from checking accounts typically looks like this: 60 to 70% from loan interest on deposits, 20 to 30% from debit interchange and other transactional fees, and 10 to 15% from overdraft, NSF, and penalty fees, with significant variability depending on the customer profile. The main costs: technology infrastructure for digital banking, customer service operations, regulatory compliance, like fraud prevention and anti-money laundering controls, and branch overhead for traditional banks. Technology and compliance alone can consume 30 to 40% of operational costs for retail banks. Technology and compliance are largely fixed costs, scaling efficiently as the customer base grows. Variable costs include transaction processing and customer service. These rise with volume, but are relatively modest per account. Don't overlook customer acquisition and retention costs. Bonuses, marketing, and referral programs can eat into the first-year profit from new customers. Fraud losses and charge-offs from negative balances are also perpetual risks. Gross margins on checking accounts can exceed 60%, with net margins typically around 25 to 30% after overhead. That's higher than supermarkets or airlines, despite the product being free. Compared to the broader banking industry net margin of 20 to 25%, checking accounts are, in the right context, a quietly lucrative business. So why are checking accounts free? It's all about the loss leader pricing model. Banks remove monthly fees to attract deposits, confident that the cross-sell and downstream economics will turn a profit. The real price is paid indirectly through overdraft, loft interest, and interchange margins. But not all customers are free. High-balance, fee-averse users subsidize the cost for others who frequently overdraft or use out-of-network ATMs. Student and senior accounts, premium tiers, and bundled products are all classic examples of price segmentation at play. The psychology? Free draws masses in, but the subtle maze of fees, thresholds, and exceptions means many still end up paying, especially over time. Inertia, loyalty, and the hassle of switching keep customers locked in despite mounting costs. Compared to fintech startups like Chime or Cash App that advertise truly fee-free banking, legacy banks still dominate because of their physical networks, broader product suites, and brand trust. However, the threat from neobanks is pushing traditional banks to trim the most egregious fees, at least publicly. Typical customer journey: see a free offer, sign up easily, enjoy digital or branch convenience, gradually add direct deposits and bill pay. For many, the journey ends with a costly overdraft, out-of-network ATM, or upsell to a new product. For customers, the value comes from convenience, safety, and wide acceptance. Banks tap into basic needs and reinforce trust with FDIC insurance and seamless digital services. Major banks benefit from huge network effects: branches, ATMs, accepted billers, high switching costs, direct deposit headaches, bill pay migrations, heavy regulation, and deep brand loyalty, making disruption hard for new entrants. At scale, banks automate back-office work, leverage massive IT expenditures, and standardize pricing, squeezing ever more profit per customer account. This keeps average servicing cost per account typically under $50 annually. The big innovation? Transforming customer deposits into a high-margin lending engine, while hiding the true cost of free behind a web of optionality and behavioral nudges. Digital banks have further streamlined costs, flipping the old model on its head. Switching checking accounts still means paperwork, missed bill payments, and changing direct deposit, a set of frictions banks are in no rush to address. Loyalty programs, VIP tiers, and bundled services all aim to keep customers from leaving. Banks expand by cross-selling: credit cards, auto loans, investment products, further monetizing each relationship. Some buy fintech upstarts or introduce their own digital-first brands to capture younger demographics. But risks abound: regulatory crackdowns on overdraft fees, rising competition from fintechs, pressure on lending margins as interest rates change, and shifting consumer expectations about transparency and fairness. Key takeaway: free checking is rarely free in practice. Banks profit handsomely by leveraging deposits, interchange fees, and a tapestry of charges, while keeping most costs hidden from view. Consumers should be savvy, know where your money sits, monitor for hidden fees, and consider alternatives if your needs are simple. That free account could be quietly eroding your wealth. For investors, sticky checking relationships are gold: predictable, diversified, and scalable sources of profit. But watch for regulatory risk and fintech disruption as key long-term threats. The broader lesson: free can be a powerful hook, but only when coupled with hidden or indirect revenue that scales with growth. Pricing strategy is about psychology, not transparency. Have you ever been surprised by a hidden bank fee, or do you completely avoid them? Let us know in the comments how you navigate the world of free banking. Looking ahead, expect more transparency, fintech-driven innovation, and ongoing battles over fee structures and customer stickiness. But as long as banks hold your deposits, the game is stacked in their favor. So the next time you see a bank advertising free checking, remember, it might be free, but it's never without a cost. Up next, how do credit card companies profit beyond just interest rates and late fees? Stay tuned for the next collapse case.